Welcome to today's discussion. Last time I introduced to you what accounting is and specifically talked about financial accounting, that is, reporting financial activities to those that are not directly involved with managing and operating the company. That's external users like customers and government and auditors and stuff. Today, I'm going to continue with lesson 2, which is accounting equation. If you haven't seen the previous video, please go to my channel, click in playlist and watch lesson 1, the introduction to accounting or financial accounting. We're going to talk about, obviously, the accounting equation. Okay, every company, okay, has resources, but those resources must be owned by someone. Okay, if a company has a building, if a company has a car, if a company has equipment, someone must claim ownership of those equipment. It could be the owner of the business. He started it, so he said, okay, I bought this car to start the business, so I own it, it's mine. Okay, that is what accounting equation does. It's a system that describes a business entity's collection of assets, which is resources. Okay, in accounting, resources are termed as asset. So whenever you hear assets, it simply means resources of a business. Okay, and the corresponding claims against those assets. So if you start a business and you are lucky that the bank lends you money to buy a building or to buy a car to run your business, the bank has ownership of the car until you pay off that amount that you borrowed. Okay, that is what accounting equation does. It tells us the business has this amount of asset. This person owns it. These people own some. This person owns a portion of that asset. Okay, so that is what accounting equation is all about. It's not anything difficult. It's not anything crazy or anything scary. It's simply telling you these are the resources the company has. On the other side, these are the people that can claim ownership of those assets. That is the accounting equation. Okay, so I'm going to take you through a few examples that I've written. I've written all these myself. A few examples that I've written and take you through. Let's see. And ownership, when we talk about ownership, we could have more than one person owning a business. Okay, but specifically for this video, I'm going to focus on what we call a sole proprietorship. Okay, sole proprietorship means the company is owned by one person, but we have situations where a company is owned by two or more people, or even a company decide to share to sell shares to others to be part of it. We call those share owners. Okay, so we have share owners, we have members of a company, and we have owners equally. That's just one person for sole proprietor. So for the sake of this video and for the sake of those who are starting to take accounting classes, we're only going to dwell on a company owned by one person. Okay. So in this case, the accounting equation is termed as asset is equal to liabilities plus owner's equity. Okay, so asset are resources the company owns. Okay, liability is what owes to others, what the company owes to others, and then equity is what is owes to the owner. Okay, so if you have an asset, on the other hand, the asset you probably owes a portion of the asset to someone and the remaining is yours. Okay, so imagine you started a business. Okay, you needed 50,000 to get the business started. You have 30,000 there. Okay, and someone lends you 20,000. Your asset is you have 50,000 capital. Okay, but 20,000 belongs to someone, and then the remaining 30,000 is yours. So your accounting equation is always going to be assets equal to liabilities, what you owe someone, plus what you own or the company owes you. So the equity is a portion of the asset belonging to the owner. or belonging to the owners or belonging to the shareholders. That's what we call the equity. Okay, so asset will always be equal to liabilities plus owner's equity. You can have a situation where you know what the equity is, okay? You know what the asset is, but you don't know the liability. That is where you do the accounting equation. You take asset and you subtract equity, because when you flip it, it becomes negative. When it goes opposite of the equal to sign, it becomes negative. So asset minus equity will give you liability, or asset minus liability will give you equity always, all the time. Okay, now let's talk about what asset is, okay, and give some few examples. Okay, so as I've mentioned again and again, they are resources that the company owns, and this brings about future economic benefit because you're going to use those assets. There are some key points that you have to I will point out to you. Okay, you're going to use those assets to have benefit in the future. If you have a car, you're going to run the car, and the car will bring income. That's why asset brings economic future benefit. Okay, so asset could be a cash, a building, equipment, or anything that is tangible that you can touch, or anything that the company uses to generate income. Okay, so in this example, let's assume, okay, a company delivers 5,000 worth of goods. Okay. So your company and deliver 5,000 worth of goods to your customers. Okay, the company, although you haven't received that money, your company own that $5,000. So in here, the customer owes you money. Okay, so this is what we call receivables because you are yet to receive. And in lesson 3, I'm going to talk about chart of account. Okay, so chart of account will tell you all this. I will introduce you to receivable and payable. But for now, keep in mind that receivable means money you are yet to receive. Payable means money you are yet to pay. Okay, the names and the wordings explain what they are. Receivable, that means you have delivered 5,000 worth of goods and services, okay, to a company or to a customer, and they have not yet paid you. That 5,000 belongs to you. Okay, so it's a receivable. So this is what the accounting equation will look like when you deliver those goods. So before, let's assume you have 15,000 assets and you have 9,000 liabilities and 6,000 equity. When you deliver them, 5,000 will become receivable. So 5,000 will increase your assets. Okay, so as it increases your asset, and then 5,000 will increase owner's equity. Okay, and I've put a little asterisk there because we have something called revenue minus expenses. Okay, so but for now, keep it in mind that the income goes to owner's equity. Okay, there could be a case that you have to take out some numbers or some things that you sold, okay, or expenses that you ran. Okay, but for now, receivable will increase your asset. So after delivering, your asset will increase to 20,000. Okay, and then your liability will stay the same because you don't owe anyone anything for now. You still owe the same 9,000, and then 11,000, which is the increase of 5,000 on top of 6,000. When you add this together, we have 20,000 on the right hand side and 20,000 on the left hand side. So the accounting equation, the left and the right hand side will always be equal. Okay, so the liability and equity will always be equal to the asset. Okay, let's look at another example with the liabilities. Okay, so these are amount owed to others, and this could be customers or creditors. Okay, it could be a bank that you borrowed money from, or it could be a customer that you have to deliver something to the customer. It doesn't always have to be cash involved. Okay, it can be an obligation that you have to perform. For instance, if a customer pays you money, okay, I have an example here. Okay, so let's assume this example. Okay, you are a catering service. Okay, you have a catering service and you collected 2,000 from a client in an agreement to provide and serve food at her wedding. Okay, so you say, okay, I've taken you 2,000. I'm going to serve food there because I do a catering service. Okay, Your entity is now responsible for performing a service worth 2,000. Okay, so here your company isn't responsible for paying 2,000, but it's responsible for delivering a service worth 2,000. Because if you don't do it, you have to return that $2,000 to the client. So this way you owe the client a service of $2,000. Okay. So in this way, your cash will increase and your liability will increase as well at the same amount, which is 2,000. So let's assume before you had the same 15,000 asset, 9,000 liability, and 6,000 owner's equity. You receive the cash, so cash will increase your asset by 2,000, and now you owe the customer a 2,000 worth of service. So that becomes a liability. Liability is always something you owe. Okay. So you owe a service of 2,000. Now your asset will increase by 2,000, which makes it 17,000, and your liability will increase by 2,000, which makes it 11,000, and then the equity still stays the same. So when you add the liability and equity, we have what 17,000. So we know the right-hand side of the equation is always equal to the left-hand side of the equation. So asset is always equal to liability plus owner's equity. Let's move on and finish off with what equity is. Okay, what equity is. And as I read, this is what belongs to the owner. And it could be owners or members or shareholders, as I've explained previously, okay, or at the beginning of this video. We could have more than one person owning a business. Okay, it could be two person, or it could be even a family business. All those are members. Okay, they own it. Okay. So this could be an initial investment. So if you start a business and you start a business with a capital of 20,000, that 20,000 is your equity, okay, because that is how much you started with. Okay. And to go more, we see subsequent gains and losses, increases and decreases equity respectively. So at the end of the period, if you have any gains, the gains come to you as a owner or goes to the owners, and that increases the owner's equity. Okay. And if you do any additional investment, okay, so you're running a company, the company is growing, and you realize you have some money somewhere and you want to invest in the company, that also increases your capital. It increases your equity because you are adding more money. But when you take out money from the business, that decreases your equity because you are withdrawing money. You are withdrawing money from the business. Okay, and simply, equity is always equivalent to asset minus liability. Like we did here that I showed you, equity will always be asset minus liability. So if you don't know how much your equity is, look for your asset, look for your liability, take the asset, subtract liability, and you have your equity. Okay. So let's look at an example here. For instance, imagine that you decided to take 3,500 from your business, okay, from your small business here to buy a car or a motor. Let's assume you would buy a used motor for a personal use. In my previous video, I talked about a principle we call the economic entity principle or business entity principle. Okay, that separates personal use from business activities. Here, you have taken the money to go buy a motorbike for your personal use. You're not going to use it for the company. Okay, so this is what happens when you draw the money. Let's assume we still have the 15,000, we still have 9,000, 6,000. Both sides of the equations are equal to each other. When you drew the money, 3,500 or 3,500 reduces your asset. Okay, so you will now have an asset of 11,500. Cash is an asset, so you're taking an asset out. Okay, your liability will still stay the same as 9,000, but your equity will decrease to 2,500. That is 6,000 minus 3,500 gives us 2,500. So when we add these two together, we have 11,500 or 11,500, which is equal to the left-hand side of the equation, which is the asset of 11,500. So now this is an example of equation. Let's give another example. Like you took this same 3,500 from your business entity to buy equipment. So here you are buying an equipment, okay, for business use. Buying equipment for business use, okay. The equipment is going to generate income for the business. So this is not for a personal use, but for a business use. Let's look at what that will also be. Okay, so before that you have your 15,000, 9,000, and 6,000 all the same. Okay, but what happens is when you buying the equipment, okay, your cash is reduced by 3,500. Okay, but the equipment is coming to the same company, so it's like going and coming, outflow and inflow. Okay, but this doesn't deal with cash to out. So we have a cash, you're exchanging cash with equipment. Okay, you're giving out cash, so you'll get an equipment. And the equipment is worth 3,500. Okay, so your asset will still stay the same at the end. The reason why this asset doesn't change is this equipment is coming to the company. Okay, but the motorbike wasn't coming to the company, it was going to the owner. So the owner has to take responsibility. That is why it comes out from his equity or her equity. He has to take responsibility of that. Okay, but here the company has to take responsibility of that. So it goes out, cash 3,500 goes out, and equipment of 3,500 comes in. Okay, so at the end, our asset is going to stay the same with $15,000. Okay, liability didn't change, equity didn't change, and we still have 15,000 on both sides of the equation. Let's give a last example, and then we will get ready for our third lesson. Okay, and this is an example too. Let's assume that you took 3,500, okay, to pay off loan. So you owe a bank, your company owes the bank, and you decided we're going to pay 3,500 so we can reduce payable, the things we have to pay. Okay, now in the same scenario before, we have 15,000, 9,000, and 6,000. So cash of 3,500 is going out. So that is reducing your asset. Remember, cash is always an asset. It's one of the most active assets, okay? And your liability, you owe the company or you owe the bank 9,000, but you are paying 3,500. So that reduces how much you owe the bank or how much your company owes the bank. So that reduces it by 3,500. So at the end, we have 11,500 assets. We have 5,500 liability, and equity stays the same. Add them together, these two, we have 11,500. So on the left side of the equation is always equal to the right hand side of the equation. So if you need help, you can pause this video and read the little note that I've made. I came out with all these to make it simple and even simpler than what you have been reading in your notebook and in your textbook. Okay, so I hope this gives you some clarification of what accounting equation is. Is simply all the resources that the company owns, showing the corresponding claims or those who can claim the asset that the company owns, and the liability are what the company owes to others, what the company owes to the owner, or what the owner can have a claim of. So others can have a claim, a portion of the asset, that's liability, but the owner can also have the claim of the remaining asset. Okay, so thank you for watching this video, and in our next video I'm going to talk about lesson 3 with a chart of account. Okay, so we're going to talk about chart of account, and all these assets have account. Okay, asset have account, the account that belongs to asset, account that belongs to liability, the account that belongs to equity. Okay, and I've told you, always remember, once you see receivable, it means something you are yet to receive. Payable, something you are yet to pay. So thank you for watching this video, and share with your friends, and I hope you do good in your classes.